Hello everyone, and welcome back to our class in financial risk management. Last week I started to discuss the derivation and the more or less the proof of the Black-Scholes model, and actually we talked a lot about the assumptions we need. As you might remember, and as you can infer from the heading of this slide, we assumed the underlying price, usually the stock price, to follow a geometric Brownian motion. Now this is an assumption we make, and actually this is the assumption we make. We don't assume the stock returns to be normally distributed. We don't assume the prices of the underlying to be log normally distributed. We are assuming the stock price and the log returns to follow a Brownian motion and geometric Brownian motion respectively. What follows from the assumption of the geometric Brownian motion is the normal distribution of the log returns, and this is the assumption we make. Now we also assume that, for example, the derivative, the option, is written on a stock that doesn't pay out dividends. We don't have transaction costs, and so on. We'll come back to those numerous assumptions on the perfect capital market we are in from the Black-Scholes model later on, but the most important assumption we have in this model is the geometric Brownian motion. Now, this summary, I guess, tells you everything we need. The stock price follows a geometric Brownian motion, meaning what? The change in the stock price, the continuous change in time in the stock price, DST, is given by a diffusion process in which we have, first of all, a drift. Where's the cursor? Here, okay. Where we have a drift that with every minuscule change in time, we have the stock price that can go up and it can go down. And the question whether it goes up or goes down or stays the same in the drift component is governed by this parameter mu. And if we multiply mu with st, if st is included here in drift and diffusion, then we have a geometric Brownian motion. Otherwise it would simply be mu dt plus sigma dwt. Now, the stochastic behavior is actually included in this and inserted in this by including changes from a Wiener process. Now, the Wiener process, as the simplest diffusion process, was characterized by normally distributed independent increments. So in other words, it's simply the time series, the stochastic process variant of the normal distribution. So it's not constant over time, every time it's a normal distribution, but the changes, the increments, SD, for example, ST minus 1. Those increments are independent over time and they are normally distributed. That's the dwt here at the end. And we have a parameter sigma, which increases or decreases the resulting variance. And the variance can, of course, then afterwards also be time varying. So this is the geometric Brownian motion. That's the model we assume for the underlying price. Okay, now we are interested not just in the stock price. We have just made an assumption and we've just made a modeling assumption on the stock price. So we are not really, we shouldn't be, how should I put it? We shouldn't be surprised by the time evolution of the stock price. Why? Because we've already modeled the stock price time evolution. So if we assume, okay, the stock price can move like this, well, that's our model and we are not surprised by any ups or downs of the underlying price. But what we are interested in, how does a function in S and T look like and how does it evolve over time? Now, the beauty of this model, and this is actually something that is lost in most German textbooks, is that we are talking about a function in the stock price and in time. It's a function. We don't say this is the payout profile of, let's say, an option. We don't say this is a put, this is a call. It can be any derivative. And later on we'll see that the Black-Scholes model is applicable to all derivatives. It cannot be solved for all derivatives, but the model itself is extremely general. And if we say, well, the price of an option is a function in the price of the underlying S and in time, then of course we are interested in the price changes, df. So which price change, df, is induced by a change in the underlying price, ds. So that's what we're doing next. And for this we need a famous lemma, Ito's lemma. If you don't know what a lemma is, it's a mathematical theorem that is used to show something else. In German we would say Hilfssatz, lemma. We are not trying to show this. We are not trying to show this result, but we are actually trying to prove something else. But we need this Ito's lemma. And what does Ito's lemma say? Well, we are interested in the change df of a function in S and T. Now, if we take the total differential, das totale Differential, let's do Taylor transformation, then we have to write out its Taylor series, die Taylor-Reihe. In this case, the Taylor series is given by partial derivative of f with respect to s times ds plus partial derivative of f with respect to t dt plus half the second partial derivative of f with respect to s differentiated twice with the squared term ds. Same for dt. Then 1/3 third partial derivative, and so on and so on. And this is exact. Say this in German. I hope you understand this a little bit better. Ich hoffe, Sie haben in der Mathematik die Taylor-Reihenentwicklung gesehen, in der Analysis. Die Taylor-Reihenentwicklung sagt Ihnen ja, etwas grob gesagt, dass wenn Sie eine differenzierbare Funktion haben, dass Sie dann zumindest lokal den Satz von Taylor beweisen können, der da besagt, dass eine Funktion, die differenzierbar ist, an einer bestimmten Stelle, zumindest in der Umgebung, also eventuell in einem sehr, sehr kleinen Intervall um diesen Punkt herum, dass diese Funktion dann ersetzt werden kann. Man spricht dann in der Mathematik von dargestellt werden kann. Das heißt letztlich, es gibt was anderes, was gleich ist, nämlich es kann ersetzt werden durch die sogenannte Taylor-Reihe. Die Taylor-Reihe ist eine unendliche Summe von letztlich Polynomwerten. Ja, von Polynomen, von Monomen. Und das Interessante ist, dass die Koeffizienten dieses Polynoms am Ende die Ableitungen, die partiellen Ableitungen und im eindimensionalen natürlich die gewöhnliche Ableitung und die höheren Ableitungen der Funktion selber sind. Die Ableitung, man muss dann auch noch den Punkt, den Entwicklungspunkt einsetzen, liefert Zahlen zurück. Und das sind die Koeffizienten und das, was folgt, sind letztlich Polynomglieder und Monome. Und das Interessante aus mathematischer Sicht ist jetzt, dass Sie eine x-beliebige Funktion, die kann aussehen, wie Sie wollen und sie muss nicht bekannt sein, in einem Punkt, wo die Funktion differenzierbar ist, zumindest in einer hinreichend gegebenen kleinen Umgebung dieses Punktes, ersetzt werden kann durch eine Polynomreihe, durch eine Potenzreihe. Und das ist schon, zumindest aus mathematischer Sicht, sehr interessant, weil Sie wissen eigentlich nichts über die Funktion selber. Sie können sie aber an einer Stelle approximieren, und noch nicht mal approximieren, Sie können sie ersetzen durch eine sehr einfache Funktion, die sehr einfach gestrickt ist. Und Sie sehen das ja schon hier letztlich im Grunde genommen ein Polynom. So, eine unendliche Reihe. Was macht man denn dann häufig in der Praxis? Weil Sie sehen ja, das ist eigentlich eine unendliche Reihe. Das, was man dann häufig macht, ist, man macht einfach eine Taylor-Abschätzung und man nähert sich dieser Taylor-Reihe in erster Ordnung linear, in zweiter Ordnung und so weiter. Das heißt, man vernachlässigt einfach die Terme am Ende. Man schneidet ab an irgendeiner Stelle. Und das machen wir jetzt hier auch in ähnlicher Weise. So, let's switch back to English. So we do a Taylor expansion of df, and what we can see here, if we simplify this a little bit, we first of all take the partial derivative of f with respect to s, and we see, well, in here we get some function a in s and t, dt, plus a function b, st, dw, plus, and the partial derivative of f with respect to t, dt, plus, and so on, and so on. And what we can see here in the end is that everything else includes the term dt squared, or dt taken to the third power or fourth power, and so on. And everything here, and this is something where we have a lot of these terms, actually infinite terms, but it is interesting because at this point we can say, well, dt in continuous time is a very, very small change in time. If we square this, it will get even smaller. So what we do is, at least as an approximation, we neglect everything else. So everything that includes the factor dt taken to the nth power with n larger than 1, 2, 3, 4, and so on, we can neglect all of this. So actually df becomes only, where's my cursor here, becomes this. This part and this part. Now we need to simplify this even more. Now we get, as a first result, the expected value of the squared difference in the Wiener process is dt. We simply take that as a given. The variance of the squared Wiener process is dt squared. So as you can see here, we have dw squared, and we need to work with this. So actually, as you can see, in linear approximation, in dt, just as before we said, well, dt is very small and dt squared will be even smaller. So we can assume that actually this is close to 0. If the variance of something, in this case dw squared, is 0, it's no longer stochastic, it's deterministic. And if something is deterministic, it can be substituted with the expected value, which is in this case the only value. So if the variance is 0, dw squared can be approximated using the expected value, in this case dt. So simply substitute this and say, well, this is dt. Makes life a little bit easier. And now, if we know that dw is approximately the square root of dt, and if we ignore all values below dt, so dt squared, dt taken to the third power, and so on, at last we get Ito's lemma. Now, Ito's lemma states, a little bit imprecise, but suffices for our purposes, that for an infinitesimally small change in time dt, the change in a function in time and a diffusion process S follows a diffusion process, is given by df equals partial derivative a plus partial derivative plus second partial derivative b, everything dt plus dw. Or if we substitute a by using mu and b by using sigma, you can actually see what? Let me use something to highlight this. We mark it, yes. We have a parameter. This is nothing but a parameter. We could also say this is mu. Oh, sorry. Let's call this mu tilde. And this one here, let's call this sigma tilde. And what you can see is that the change in the function of a diffusion process is again a diffusion process. Mu tilde dt plus sigma tilde dw. Was Sie sehen, das ist das Ito-Lemma, das ist die zentrale Aussage. Wenn Sie für S einen Diffusionsprozess unterstellen, dann folgt eine beliebige Funktion f in S wieder einem etwas anderem Diffusionsprozess. Mit anderem Parameter μ, mit anderem Drift, mit anderer Diffusion. Und Drift und Diffusion sind gegeben durch diese beiden Ausdrücke hier mit den partiellen Ableitungen von f nach S und t. That's the result. Ito's lemma states that if you assume for the stock price, for the underlying price, a diffusion process, any derivative will also follow a slightly different diffusion process, which then is also called an Ito process. You can also simplify ethos lemma to df equals to, and so on, dt plus partial derivative dst. That's the difference, not dw, but dst. We don't need this, but we now have everything in place to derive the Black-Scholes pricing formula. So we start out with the value of a derivative on the stock S at time t. Underlying follows dst with a general diffusion process, a parameter dt plus parameter b times dw. We can write this a little bit different. As you can see, if we take the average yield and volatility, we can also write this as a geometric Brownian motion. You see that suddenly S drops in here. This is not really relevant, but we start out with the value of a derivative. We now call it not f, but we call it v for value. Any derivative, we haven't talked about whether it's a put, a call, whether it's an arithmetic agent option, etc. It's any derivative. The change in the price of the derivative is given via ethos lemma by partial derivative with respect to time plus half squared diffusion or volatility times s squared times the second partial derivative of f with respect to the stock price, dt, plus partial derivative with respect to the stock price, again, ds. Okay. Now, again, on a side note, it might sound somewhat less compelling to use ethos lemma at first, because why should we want to consider a general function? Again, I cannot stress this enough. The beauty of this whole model is, and this is all, you should have a look at any German textbook on risk management and banking especially. All these textbooks say the Black-Scholes model, the Black-Scholes formula is a formula for put and calls. Yes and no. Yes, it can be used for puts and calls, and this is where you get very nice results, but the Black-Scholes pricing framework is applicable to all derivatives. Can be done on any kind of option. So we now want to look at the change in the value of the derivative dv. Now, we now form the following portfolio. We buy the derivative, so we go long in the derivative, and we go short in the underlying, and we go short in the amount of delta underlying. So could be 5, could be 10, could be 20. We leave this as a parameter. So buy one derivative and go short in delta underlyings. The value of this portfolio is simply given by pi, and the change in the portfolio value is given by d pi, which is the change in the value of the option, of the derivative, minus delta times the change in the underlying price, ds. Now we know dv from ethos lemma is given by this. This is ethos lemma, and at the end we have minus delta ds. Simplify this, and you get d pi equals yada 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 dt plus partial derivative of the option with respect to s minus delta ds. And now comes something that is a little bit tricky, or even sneaky. We see this portfolio, and this portfolio is risky. You buy a derivative and you go short in the underlyings. Now, what we often do to show that something is arbitrage free and that a price is fair is to duplicate it with something that we know. And in this market, we only know one price for sure, that is the risk-free asset. The risk-free asset, let's say we have R as the risk-free rate, could be from a government bond. And we want to make this portfolio risk-free, and if it's risk-free, it should pay the risk-free rate. But how to make this portfolio here, if this is the change in the portfolio price, how to make this risk-free? Well, if you have a look at this, the change in the portfolio value is given by yada 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 dt, and this here, all of this is risk-free in the sense it's deterministic. It's not stochastic. The only thing that is stochastic is this last part, because it includes ds, the change in the underlying price, which we don't know. So this here is stochastic. But this whole term vanishes if the partial derivative with respect to s equals delta. In that case, this parenthesis becomes 0. 0 times ds is 0, and the change in the portfolio value becomes deterministic. And if something has a deterministic change in price, it's risk-free and should pay the risk-free rate. So that's actually what we need for the derivation of the Black-Scholes formula. So in the end, we choose delta to be the first partial derivative of the derivative price with respect to the underlying price. This is famous, and this has a special name. This is a delta hedge. This is the famous delta hedge because you choose delta as the option delta. The first partial derivative of the derivative with first partial derivative of the derivative with respect to the underlying price is called the option or derivative delta. Ja? Haben Sie vielleicht ja mal gehört, es gibt die sogenannten Griechen, die partiellen Ableitungen des Optionspreises. Das ist hier genauso eine partielle Ableitung, das ist nämlich das Optionsdelta. Und wenn Sie das Optionsdelta nehmen, nämlich die partielle Ableitung nach dem Underlying Price, und wenn Sie ein solches Portfolio erstellen mit einer Short-Investition und Sie gehen mit genau Delta Underlying Short, dann nennt man das einen Delta Hedge. It's called a Delta Hedge. It's a perfect hedge because, as you can see, if you choose Delta to be the first partial, the option Delta actually, then the change in the underlying, in the portfolio price becomes deterministic and thus it's risk-free. So it's a perfect hedge. You have no risk left. Then, if you choose delta to be the option delta, then everything becomes deterministic, and as you can see, you only have left d pi equals this whole term dt, and this should pay the risk-free rate. So d pi should actually be r times pi times the change in time. So you get 5% times the change in time. So the period you keep your portfolio times maybe 1 million, because pi is the value of the portfolio. So the change in the portfolio value is 5% times 1 million times 3 months. Actually, we're in continuous time, so it's probably a very, very small amount of time, but that's d pi. So what you do next is take this and set these two terms equal. And we're done. What we get is the Black-Scholes differential equation, die Black-Scholes Differentialgleichung. For a portfolio of one option, long, and delta underlying short, the change in the portfolio value is given by, and as you can see, simply bring it to the other side and set it to equal to 0. You get the partial derivative of the derivative with respect to time plus half sigma squared s squared times the second partial derivative of the option with respect to the stock price plus risk-free rate times stock price times option delta minus the portfolio value times the risk-free rate. This needs, for arbitrage reasons, needs to be equal to 0. Now this is a requirement for the option price to be arbitrage free. This is a differential equation, and differential equations have functions as solutions. So we are looking for a function v that fulfills this differential equation. Sagen wir es mal so, gibt es jemanden, der nicht weiß, was eine Differentialgleichung ist? Denken Sie daran, ich nehme noch auf, also entweder schreiben Sie kurz in den Chat ja, dann sehe ich zumindest, dass die Anzahl der Chatnachrichten hochgeht, oder Sie machen doch nur kurz das Mikrofon an und sagen, ja, ich oute mich, ich weiß nicht, was eine Differentialgleichung ist. Ansonsten stelle ich das jetzt einfach mal als bekannt, setze ich das als bekannt voraus. Melden Sie sich jetzt oder schweigen Sie für immer? Alle wissen, was eine Differentialgleichung ist. was man als Lösung einer Differentialgleichung herausbekommt, und vor allem Eindeutigkeit, Mehrdeutigkeit und Lösbarkeit von Differentialgleichungen sind Ihnen bekannt. Gut. Okay. So you know what a differential equation is. You know that a differential equation has functions as the set of solutions, and first of all, we need to solve this differential equation, and in order to solve it uniquely and get a unique solution, we usually have to look for a boundary condition to show that the differential equation has a unique solution. But before we do this, let me summarize the main assumptions we've made. First of all, the underlying follows a log normal random walk geometric Brownian motion. The risk-free interest rate is a function of time. That's uncritical. Underlying does not pay dividends, would only make the model a little more complicated. Delta hedging is continuous, and we have no transaction costs and no arbitrage. Well, no arbitrage is okay. No transaction costs, that's usually a pretty hefty assumption you have to make. And the delta hedging can be done in continuous time, also in unendlicher Schnelligkeit kann jederzeit das Portfolio umgeschichtet werden. And rehedges are possible in continuous time. That's highly implausible. So that's also an assumption that is a little bit unrealistic. Okay. Now we've seen the Black-Scholes differential equation, and be careful not to confuse it with the Black-Scholes formula or formulas. The differential equation, usually differential equations have an infinite number of solutions, yeah? And they have functions as solutions. So in order to derive at a unique solution, we need to add additional boundary conditions. Let me just correct this. At a definite, that's a unique. To arrive at a unique solution, we need to add additional boundary conditions, which must be fulfilled. And I can give you a very simple example. That's the usual one. For example, if we say we have a differential equation that looks like this. Function y is equal to its derivative, or you can also say f of x equals f first derivative of x. Now, you can already think of two functions that fulfill this. For example, y equal to the exponential function, but also y being equal to the constant zero function. So we have two solutions and there are infinite ones. If we now want to see which one is the unique solution, we need additional assumptions. We need a boundary condition. For example, you can say y of 0 equals 1. In this case, well, it's quite clear that the solution we are looking for is the exponential function. Y of 0 is 0 for the second possible solution, and if y of 0 is 1, has to be the exponential function. So we are setting some values fixed on the boundary of the solution space, and the initial value condition for the option is actually the payout profile. We know, for example, if this is the underlying price, and we are here today, we know what the option will be worth at this point in time. That's the payout at maturity. So actually the payout profile, P, as a function of S at time of maturity, the payout profile P is our initial value we need in order to at least try to solve the differential equation uniquely. And that's what we do next. Now, we are taking a shortcut. Actually, remember, this is the differential equation. I don't want to solve this. This is a stochastic partial differential equation. I don't want to solve this. So I go to my colleagues in the mathematical physics department, or in the section for differential equations, and this differential equation is actually well known in mathematical physics. It's the so-called heat or the diffusion equation. It describes how, for example, heat travels through a rod of steel and how molecules fuse into another liquid. Ja, also diese Differentialgleichung ist in der mathematischen Physik bekannt. Das ist die sogenannte Wärmeleitungsgleichung oder die Diffusionsgleichung, relativ ähnlich. Da geht es zum Beispiel darum, wenn Sie einen Metallstab nehmen oder eine Stange und Sie halten an ein Ende ein Feuerzeug, dann ist ja die Frage, wie wärmt sich dieser Metallstab langsam auf. Hat auch mit der Wärmeleitung zu tun, wahrscheinlich auch mit dem Widerstand und. Und das kann man mit Differentialgleichungen beschreiben und das ist genau diese Differentialgleichung. So, lucky us, we have a solution and the solution that our mathematicians have found is the following, depending on the payout profile P. So be careful. This is the solution V. It's no longer dv or something, but v, the function v, the price of the derivative is given by exponential function, square root of 2 pi, and so on. And now be very careful. This is here, this is the tricky part. This is an integral, and we need to solve this. Now, depending on p, here, depending on p decides whether this integral can be solved, whether you can integrate this function or whether you cannot analytically. Ich sage das auch nochmal kurz auf Deutsch. Das ist letztlich hier die Lösung. Exakt, ne? Deswegen auch das Gleichheitszeichen. Der Preis des Derivats ist dieser Ausdruck e-Funktion geteilt durch hier Wurzel 2pi und so weiter mal das unendliche Integral in Abhängigkeit dieses Payout-Profils P. Ne? Wir haben nichts gesagt, ist noch kein Put, ist noch kein Call, ist egal, ist irgendein Derivat und dieses Integral müssen wir jetzt lösen. Und wie Sie das ja schon mit simpelsten Integralen aus der Schule kennen, integrieren ist haarig. Ja? Und integrieren, in manchen Fällen geht es, in manchen Fällen geht es auch nicht. Und das entscheidet sich tatsächlich hier immer in Abhängigkeit von dem Payout-Profil. So, this is the exact solution of the option price as a function of the payout profile P. Now let's have a look at one example that is a plain vanilla call. The plain vanilla call has the payout profile maximum of stock price minus strike or 0. So let's insert this. As you can see here, we now have one difference. Let me highlight the differences. Okay, 0. And as you can see here, payout. And we now has S minus K here. And that's the Black-Scholes solution. Now, if we multiply all of this with the exponential function, with the parentheses, if we divide this into the difference between two integrals, and then note that the integrals are actually the ones that we know from the normal distribution, then we don't need to solve this analytically, but actually we know that this function is actually given by stock price times normal distribution minus strike discounted second cumulative distribution function of a normal distribution. This is again the analytical solution. And we finally arrived at our arbitrage-free, fair, Black-Scholes option price for a European plain vanilla call option under the given assumptions. And D1 and D2 are given by these expressions. Ich sage das auch nochmal auf Deutsch, weil es so schön ist und weil Sie jetzt hoffentlich auch sehen, wie so dieses Modell einen Nobelpreis wirklich auch verdient hat. Denn wir haben im Grunde genommen bis hier haben wir jetzt alles hergeleitet für ein x-beliebiges Derivat. Wenn Sie jetzt auf die Idee kommen, Sie nehmen 3 Calls, Sie multiplizieren sie mit der Erdrotation und haben dann ein Auszahlungsprofil mal, ich weiß nicht, die Followerzahl von Kim Kardashian bei Instagram und Sie nennen das Ganze jetzt, das ist jetzt mein Mondderivat oder wie auch immer, das ist jetzt mein neues Instagram-Derivat, könnten Sie es theoretisch mit Black-Scholes bepreisen. Sie müssen nur hier hinten das Payout-Profil einsetzen und hoffen, dass Sie dann dieses Integral gelöst bekommen. Klar, wir unterscheiden ja gerade schon Plain Vanilla und exotische Optionen, weil Plain Vanilla, da können Sie das Integral lösen, exotische Optionen, da können Sie es nicht lösen. Aber bis hierhin kommen Sie immer. Das ist alles gleich für jedes Derivat. Dann nehmen Sie das Payout-Profil und müssten, das kann man auch tatsächlich hier per Hand gut machen noch. Sie setzen das ein und Sie splitten das im Grunde genommen auf. Sie ersetzen da ein bisschen was, Sie ersetzen die Parameter und Sie sehen ja schon hier, irgendwie ist das ein Integral der E-Funktion mit irgendwie irgendwas geteilt durch Sigma Quadrat, ne? Und das Ganze integriert und dann sehen Sie, das erinnert doch stark, auch vor allem sehen Sie mal hier vorne, E-Funktion 2Pi, das erinnert doch sehr stark an eine Normalverteilung, tut es auch. Und das, was dann rauskommt, ist, wenn Sie D1 und D2 so ersetzen, dann ist im Grunde genommen hier der Plain Vanilla European Call, der Preis ist gegeben mit Stockpreis, Aktienpreis mal Phi D1 minus Strike diskontiert mal Phi D2. That's the Black-Scholes price for a European call option. Okay. Now, if we do the same for a put, we also get an analytical solution. If we do this for a digital call, which is simply a call that pays out not the difference, but it always pays out 1 if the difference is positive or 0 otherwise, using the Heaviside function. As you can see here, the result is even simpler. Yeah? You only have the exponential function and phi of d2. So, as a first result here, we get the option pricing formula for plain vanilla options. That's why we differentiate between plain vanilla and exotic options. For plain vanilla options, we have the Black-Scholes pricing formulas in an analytical form. For exotic options, we cannot solve this. Usually. What we then do is we use methods you might learn later on in the master's degree in computational finance. We use finite differences, we use approximation techniques, and we use Monte Carlo simulation to arrive at an approximate option price. So this is what we can do if we don't have an analytical solution. Okay. We'll talk about this. To some extent here, you'll learn some more methods in the master's degree. So that's the Black-Scholes Merton model. Any questions up to this point? Please raise your hand, write something into the chat window, and then I'll stop the recording. But if you don't have any questions, we can also continue. Okay, so then let's continue with option pricing using the binomial model. At this point, we'll also have a little bit of programming code from Matlab to see how you can arrive at the option price also with a very intuitive method. You say, well, I have the stock price here, and it can go up, it can go down. That's the binomial model, or it can stay the same. So it's the trinomial model. And then depending on these outcomes of the underlying, we can then try to price the option. You can also read about this in this book, Brandy-Mato, Numerical Methods in Finance and Economics. Very expensive, so try to read about it in the library if it's open again. And the starting point now for this discrete option pricing model, it's in discrete time because we can actually count the times and the points in time. The starting point is a financial market on which a stock can be in one of two states after one period. So it's a one period state space market. We initially have a risk-free investment. We have an interest rate of R, risk-free, and we have a stock that has an initial value of S. And it can then go up. We have to multiply S with a U, U for up. And if we multiply S with D, it can go down, so we get SD. Now, first of all, we show the following valuation result for arbitrage-free state space markets. Now, if we are given any financial securities with return C1 or C2, so two outcomes at time T1, the arbitrage-free value V0 of the financial security is given by, and this is what is actually called risk-neutral pricing. Risikoneutrale Bewertung. Risk-neutral pricing means that you have two, or in this case, two states, C1 and C2, two potential future cash flows. And the arbitrage-free price in risk-neutral pricing is given by the expected value discounted using the risk-free rate and using the so-called risk-neutral probabilities, or also the hypothetical risk-neutral probabilities. Which in this case means we take the two cash flows, C1 and C2, we multiply them with those hypothetical risk-neutral probabilities, Q and 1 minus Q, and then we have to discount this expected value using the risk-free rate, so 1 over 1 plus R. And you can also show that the risk-neutral probabilities are given by 1 plus R minus D divided by U minus D. I'm not showing this here, but actually if U and D are the probabilities, the physical probabilities, then Q is given by this expression. And we can then duplicate the financial security in T1 with a portfolio consisting of the risk-free investment and the stock. So let's do this. This is taken from the Albrecht Maurer textbook. The risk-free interest rate is 10%. Current stock price is 100. At the next point in time, the price can be 125 or 80, so it can go up, it can go down. And if we consider a put option with the current underlying price as the strike price, so K is equal to 100, then we can have a look at the possible outcomes in the next state. So actually it's 125 and 80, and the put pays the maximum of 100 minus 120, 5 or 0, so it's 0, or the maximum of 100 minus 80 or 0, so it's 20. So these two, 0 and 20, those are the two payouts of the put. And we need to replicate those using the risk-free rate and the stock. Very simple. We need to set these portfolios equal to 0 and 20. We buy X times the stock, and we invest Y into the risk-free rate, and the risk-free rate pays 10%, so 1.1. And if we solve this system of linear equations, we get X star and Y star. And actually here there needs to be a star, obviously, above Y. And this portfolio, for arbitrage reasons, because it pays the same in T1, in T2 needs to have the same price. Okay, so the put price actually here in this case is 6.06. Very simple pricing of this put in a one-state space, actually a two-state space model. We have one period of time and two possible states. Now these probabilities, as I mentioned, are called and interpreted as pseudo-risk neutral probabilities. They are hypothetical in the sense that you cannot observe them in reality, but actually you take the payout V1, you take the expected value, and then you need to discount this expected value, which you've calculated using the hypothetical pseudo-risk neutral probabilities, using the risk-free rate. Otherwise, if you were to take the physical probabilities, you would have to include a risk-adjusted interest rate, because every investor has a different risk preference. Ja, jeder Investor hat eine andere Risikoeinstellung, Risikopräferenz, andere Nutzenfunktion. Das bedeutet, der Erwartungswert müsste dann auch mit einem anderen risikoadjustierten Zinssatz diskontiert werden. Bei der risikoneutralen Bewertung geht es gerade darum zu sagen, die arbitragefreien Preise ergeben sich unter dem Martingale-Maß, man nennt das dann Martingale-Maß mit dem risikoneutralen Wahrscheinlichkeitsmaß, hier Q, indem man diese Erwartungswerte mit dem risikolosen Zinssatz allesamt diskontiert. So, that's this way. And we can now extend this model to a multi-period model. So let's take a closer look at another example. The time evolution of the stock now extends over 2 periods, and we are given a call with a term of 2 periods and a strike of 90. At time T1, the value of the option can be determined for both SU and SD, and we get the price to be 43.18 or 0.056. So this is 606 we've already seen before. So this is the two-period binomial process. Can go up, it can go down again, and we would get the 100, and we get the 64 here, and the 156.25. And what we now do is we calculate the put or call here. We calculate the value of the derivative here, and we do it recursively, and we do it again to calculate the current price. So the payouts CU and CD, they can again be duplicated, and we simply reapply the binomial model recursively, and it gives us a call price for 28. This is the call, right? A call option, yes, C0. Okay. Kann ich noch mal kurz auf Deutsch erklären, was Sie eigentlich bei der Erweiterung in ein Mehrperiodenmodell hier noch machen ist, Sie berechnen am Ende erstmal den Wert des Derivats in Groß T minus 1. Das wäre also hier. Wo ist mein Cursor da? Und dann gehen Sie rekursiv vor und dann machen Sie das gleiche für die Periode davor. Das heißt, einfach im Mehrperiodenmodell würden Sie einfach hier anfangen und dann gehen Sie dahin, wieder eine Periode davor und so weiter und so weiter. Und dann sind Sie ganz am Ende und hier haben Sie C0 und das ist in dem Fall dann hier 28. So that's the multi-period binomial lattice process. So we again use the risk-neutral approach in the multi-period case, and what we get is for the call option that the call is the expected value of the final payouts, but it needs to be discounted now over capital T periods. In between, it's the conditional expected value, and you don't need to discount over capital T periods, but only over capital T minus small t periods. And the probabilities, the risk-neutral probabilities, were given by Q and 1 minus Q. And if you remember the slides, Q was given by 1 plus R minus D over U minus D. Okay. Now, what we can do next is, actually, if this is, in risk-neutral pricing, the price of, let's say, a call or a put, now let's remain with the call, then the expected value is what? It is, as you well remember, the expected value, this is where my cursor is, it's X, the possible outcomes, times the probability of X, and you take the sum, in the discrete case, the sum over all potential outcomes. This is the expected value. Okay. Now we are using a slightly different probability measure. We are using the risk-neutral probability. So for P, the physical probabilities, we now need to use the probabilities Q. So let's do this. First of all, we have to think about what are the probabilities. Well, PQ, the probabilities are given by what? You can go up U times, J times actually, and if you've gone up J times, you can only go down capital T minus J times. Now let's have a look at this slide again. Remember that here in this very, very simple binomial lattice model, you can go, if you only have two periods, you can go up 2 times, but then you're here and you cannot go down because it's not a 3-period model. So 2 times up, 0 times down. You can go up 1 time, then you have to go down 1 time, or you can go down 1 time and you can go up 1 time, or you can go down 2 times, then you cannot go up for a 3rd time. Meaning what? That the probability for this stock price, ST, at the end is given by the initial stock price, and then it can go up J times, and if it has gone up J times, it can only go down capital T minus J times. and this is given by the binomial coefficient t over j times the probability q taken to the jth power times 1 minus q taken to the power of capital T minus j. Relativ einfache Überlegung, was sind denn die Wahrscheinlichkeiten, dass Sie am Ende hier bei diesen Aktienkursen landen? Naja, Sie können bei 2 Perioden jetzt beispielsweise zweimal nach oben, einmal nach oben, einmal nach unten, einmal nach unten, einmal nach oben oder zweimal runtergehen. Jeder Zustand hat ja diese Wahrscheinlichkeiten U und D. Das sind die physischen Wahrscheinlichkeiten und die rechnen Sie jetzt um, überführen die in die risikoneutralen Wahrscheinlichkeiten und die waren ja gerade mit Q gegeben. So. Und dann kommen Sie hier zu diesem Binomialkoeffizienten. The payout at the end, Ct, is given by the maximum of S, T minus X or 0. So, if we are interested in the risk-neutral price, C0, we need to take these probabilities times the payout Ct and discount it over capital T periods. So that's the discount factor. This here is the probability under Q, and I need another color. The maximum here, this maximum function, is Ct, and say blue, the sum of Q times, let's call it X, that's the expected value under Q. So this is C0, the discounted sum of the probability weighted possible payouts. That's the risk neutral price, discounted expected value under the risk neutral probability measure. Or in between, you can see we are now moving from C0 to Ct. We don't know, we don't really need this. We are interested in the price today, so let's look at C0. We want to simplify this even further. You can see the maximum function. This one is still hurting a little bit, so we define A in this way. And as you can see, if we define A and A dash in this way, we can substitute this here in the sum and the maximum vanishes. So what you see is 1 over and so on times Q times 1 minus Q times and the stock price times U times D minus X. And if we now define BANP as the distribution of actually the distribution function of a binomial random variable, and if we substitute Q by Q tilde and 1 minus Q by Q tilde, you get the general pricing formula for a call option in the binomial model. Stock price, ST, times a binomial distribution minus strike discounted times binomial distribution. Any idea? Have you ever seen this in another lecture? Have you any idea what actually we've just shown? Any idea? Well, this actually is the analogy of the Black-Scholes model in discrete time. And it's actually the more general framework. It's the more general model. What we can see is if we were to use the binomial model and increase the number of periods. So if we let the number, I think it should be n. If n goes to infinity, this becomes phi, the normal distribution, I should use a different cursor here. This becomes phi. This becomes phi, the normal distribution. And this here becomes the exponential function. It becomes a continuous discount factor. And actually, it's, well, the geometric Brownian motion. And for n going to infinity, we get the Black-Scholes price. So this here, the binomial model for pricing a derivative, is the general case, and the Black-Scholes price, the Black-Scholes model, is the special case of the binomial model with the number of time periods going to infinity. Wenn Sie einfach nur im Binomialmodell die Anzahl der Zeitpunkte gegen unendlich laufen lassen, dann bekommen Sie die Black-Scholes-Formel. Kommen Sie zum Black-Scholes-Modell. Also in dieser Hinsicht ist das Binomialmodell viel allgemeiner. Es ist im Grunde genommen das allgemeinere Modell, und hier sehen Sie, wenn Sie einfach nur die Anzahl der Zeitpunkte immer weiter hochfahren und gegen unendlich laufen lassen, dann strebt die Binomialverteilung, oder kann approximiert werden durch die Normalverteilung, und der Diskrete wird ein stetiger Diskontierungsfaktor, und dann sehen Sie ja schon genau die Struktur der Black-Scholes-Formel. Ne? Aktienkurs mal Phi minus Strike diskontiert mal Phi D2. Das ist also hier dann das Binomialmodell. Okay, so that's the binomial model. We will now use it to price using binomial trees. We've already learned that an option with two potential future states can be priced using risk-neutral pricing, C1 times Q plus C2 times 1 minus Q, discounted with the risk-free rate. Let's now generalize this as follows. We say that f of 0 equals the continuous discount factor times P times Fu plus 1 minus P times Fd, with P being the pseudo-risk neutral probability. And in this case, we have the exponential function of R delta t minus d over u minus d. U and d again represent these probabilities for the upper and lower state. And in the limiting case, we've seen that we get the well-known Black-Scholes model. If the differential equation underlying the Black-Scholes model cannot be solved analytically, and this is the case for exotic options, we can then use discretization strategy to arrive at a solution nonetheless. And some of these examples are the binomial, trinomial lattice processes, Monte Carlo simulation, and finite difference. So we'll start again with the binomial model and then move to the trinomial model. Now in the binomial lattice process, everything we've seen so far looked like this. S can go up, it can go down. If it goes up and down again, we get to S again. And if it goes up twice, if it goes down, then we have SU squared times D, and we set U equal to 1 over D. That's one assumption we make. Now, let's look at this the other way around. We are not building the binomial tree and the binomial model and see that it somehow, and in a special case, resembles the Black-Scholes model, but we assume that in reality, Black-Scholes and continuous time are relevant and are true, and we try to approximate the stochastic process in discrete time, and we try to discretize this. So we are going the other way around. We are coming now from the continuous time model, and we are looking at discretizing this continuous model by using binomial lattice processes. So we start with the geometric Brownian motion. Change in the stock price is RSDT plus sigma as a dW. In order for the binomial tree to approximate the continuous process as best as possible, we have to select the parameters of the binomial tree. And the binomial lattice model must be fitted to the geometric Brownian motion. The starting point is now the stock price, ST, or after a discrete time interval delta t, ST plus delta t. We know the log returns. With the geometric Brownian motion, they are normally distributed. So ln of ST plus delta t divided by ST is normally distributed with R minus sigma squared divided by 2 delta t as expected value and sigma squared delta t as variance. So if this is the first result from applying a geometric Brownian motion, we would assume and we would hope for the binomial tree to respect this as well, to give us log returns that are normally distributed. Also wenn Sie die geometrische Brownsche Bewegung aus dem stetigen Fall in diskreter Zeit natürlich mit einem Binomialmodell oder einem Binomial-Gitterprozess approximieren möchten, dann wäre eine Anforderung, dass die Log-Returns, die Log-Renditen wieder, so wie bei der geometrischen Brownschen Bewegung, wieder normal verteilt sind. So, let's do this. The expected value of the log returns, actually not log returns, but of the plane returns, is this exponential function. The variance is given by this. So on the binomial lattice process, these two conditions should be met. The expected return should be this exponential function here, and the variance of the return should be this. These are two requirements for the binomial lattice process to be as good as an approximation as possible to the geometric Brownian motion. And since we have only used 2 of 3 degrees of freedom available to us, we can also make another assumption. In this case here, we said u equal to 1 over d. We can also use different choices of u. We'll see this later on, but we said u equal to 1 over d. Then, for the binomial model, we get the expected value of the next stock price after delta t periods. We have p times u times st plus 1 minus p times d times st. Yeah? We can go up, we can go down, and the expected value is this. So if we now divide by st, we get st. Okay, so pu plus 1 minus pd has to equal this. That's the first requirement. Yeah? So p has to equal the exponential function r delta t minus d divided by u minus d. And if you can now see, if we go back, this is how you get this probability. This is how you get the pseudo-risk neutral probability. You start out by saying, well, the true process is the geometric Brownian motion, and we make the assumption that u is 1 over d. In this case, the pseudo-risk neutral probability is given by this as a result from the fact that you are fitting the binomial lattice process in such a way that the expected returns are the same, or close to the same, as the ones from the geometric Brownian motion. Now, next, we want to adjust the variances of the continuous process. Same thing here. As you can see, you need to calculate the variance of the next stock. For the continuous process, it's given by this. Equalize those two, and you get this. And assuming 1 over d is equal to u, we get this, and we solve this, and we need a tail exponential. We don't need this. The result is u approximately is the exponential function of sigma times the square root of delta t. So actually what we have is, if we set the physical probability, the risk neutral probability to equal this, and if u equals this expression, we get the famous Cox-Ross-Rubinstein model. That's the CRR, the Cox-Ross-Rubinstein model. U equals this exponential function, and the pseudo-risk neutral probability is given by the latter expression. We can also use a different, make a different assumption on u and d. Actually, if we don't assume u equals 1 over d, if we simply set the probabilities to be 50% in the two-state model, we get different results for u and d. This here, in contrast, is the Jarreau-Rudd model. It's a different calibration of the binomial lattice process model in order to approximate a geometric Brownian motion. Okay, so now let's illustrate this pricing using a binomial lattice process in Matlab. We are given a European plain vanilla call with starting stock price being equal to the strike, 50, 10% risk-free rate, sigma volatility is 40, and we're looking at an option that matures in half a year. We assume that the actual price of the call is given by its Black-Scholes price. If we insert it into the Black-Scholes formula, we get an approximate price of 6.1165. Now, this is not the true price, obviously, because the Black-Scholes model is a model. It doesn't tell you what's the real price should look like. But we are trying to approximate the continuous process using a discrete one. So in this scenario here, the Black-Scholes price is the fair price, the true price. And we will see how good our model, our binomial model, how close it can get to the 6.1165. We discretize the time to option maturity into 12 steps, so delta t equals 12. U is given by exponential function of sigma square root of delta t, d equals 1 over u, and the risk-neutral probability is 50.73%. Very simple. The binomial lattice process for the stock price now looks like this, and the option prices look like this. And as you can see, you can do this recursively. You build your lattice for all those stock prices, and then you calculate the corresponding option prices, and you arrive at a price of 6.36. So the last column of the binomial tree for option pricing contains the payments, the payout profile, and the option prices earlier are determined recursively using, for example, here this function. You need to discount using the exponential function, and you take those probabilities p and 1 minus p, and at time 0 we get the price from the binomial model, which is 6.36. The true Black-Scholes price was assumed to be 6.1165. Why do we get a difference? Well, because we discretize the whole half year into 6 steps into 6 months. If we were now to increase the number of steps, let's say we divide this half a year into weeks, we would get closer to the Black-Scholes price. Okay, finally, let's have a look at the implementation in Matlab. So let Fij be the option price in node ij. The variable j designates the event j times delta t, so for the 3rd month, 4th month, etc. The variable I is the ith node at the event, so we count from bottom to top in our lattice process. So we're going up, and we are going from left to right. This is j, and this is I hope I'm correct. You can check this. Now, capital N is the number of interval divisions, in this case 6 months. T is half a year. And the price of the underlying in node ij is given by starting stock price S, up I times, and down j times minus I. Here, this is a typo. It needs to be I. At maturity, then we have the following. The final stock price, the final underlying option price, The final option price is the maximum of 0, and stock up I times, down n minus I times, and minus the strike. Previously, we have Fij equals the two option prices, the two option prices before. If we are looking for this, we need the two before times p times 1 minus p, in a sense, and then discount this to this point. So that's Fij. And discount p, 1 minus p, and the two previous values of the option. This is how it's done in Matlab. We call this function lattice European call. As inputs, we use the stock price S0, capital K, risk-free rate, T, volatility sigma, and capital N. And we pre-compute all those expressions we don't want in our for loops. So for example, del n is just T divided by n. U, D, and P are already given, and we can calculate U, D, and P before. We then initialize our lattice, that's Gita, and we know that in the very last column of the option lattice, we have the payout. So what we're doing is lattice I plus 1 in the last n plus 1 column, we have the option payout, maximum of 0 and so on and so on. And then we go through the whole lattice recursively. As I've shown you here, we actually, let me erase all this. What we're doing is we initialize the last column, and then we take those two values and we calculate this one. We take those two and calculate this one. We calculate those two and calculate this one, and so on. And then we take these two, calculate this one. We take these two, we calculate this one. This is the double for loop you can see here. From right to left and bottom to top, lattice I plus 1, j plus 1 is the discounted expected value of the two previous values. And the price of the option then, of course, is lattice 1, 1. That is this one here. That is lattice 1, 1. Yeah? First column, first line. Okay. Now, if we now do this for 5 intervals, we get 6.3595. If we do this for 500 steps, we get 6.1140. For 1000, we get 6.1152. Let me just check what was the Black-Scholes price. 6.1165. So as you can see, we are moving closer and closer to the Black-Scholes price if we only increase the number of steps, the number of periods in our binomial model. Okay. To illustrate this convergence, this is a very small example. What we actually do is Black-Scholes price is 6.1165, and then we increase the number of steps and we plot this. And as you can see, this line here, this is the Black-Scholes price, and already with, let's say, 10-15 steps, we are quite close to the Black-Scholes price using our binomial model. Okay. Now we can already improve on this. Yeah? For example, the multiplications of the probabilities U and D by the discount factor can be excluded. The special form of this grid in the Cox-Ross-Rubinstein model also allows storing all the underlying prices in one vector. Actually, if you look at the structure of this, you can actually see that the 28.07 is here. The 35.36 is also here. The 39.69 is here. The 44, we have it thrice, so it's here. 50, 3 times. So what you can see is actually you only need these values. If you only have this vector, you can set up the lattice using only these values. So you can store, you can save on memory store and storage. So you can improve on this a little bit. So a possible arrangement of prices is shown here. You can see it's again only this vector. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and 11. So you don't need all these values. You can reduce storage space and computation time. So this is an improved version. This is the smart European call lattice. You pre-compute actually not just U, D, and P, but also the discount factor and PU and PD, discount times P and discount times 1 minus P. And actually be careful, this needs to be a small p. This is wrong here. Otherwise the program will not work. And then it's the same result, only with less computations and less memory. Okay. Sorry, I've just jumped to the very end. I'm very sorry. I need to go back approximately 100 slides. I think we're somewhere here. Yeah. Okay. So that's the improved option valuation. And you set up the terminal call values. You don't need to go through all the lattice, but the end result is also the same price. It will give you the same price, but with less computational effort, and it might be with less rounding errors. Because you do less computations, it might be that the result is closer to the Black-Scholes price, at least at a later decimal point. Okay. Now, that's the binomial model. We can extend this by looking at, let me just show you this, the trinomial lattice process. Actually, this is lattice with an A. So you can go up, you can go down, but you can also stay at the same value with the underlying. So we have 3 potential states, and this will give us the trinomial model. But I think I will start with this next week. So if you have any questions, please stay in the Zoom room. We can talk about your questions, and we'll continue with the trinomial model next week. Thank you.